to get executed within 1 year itself. The margins were adversely affected by input cost rise primarily on copper and silver. This business particularly consumes a fair amount of copper and silver, close to 20% or so. We've seen price rises in these two commodities, and this business is also seeing competitive pricing pressures. The machinery and industrial segment has grown at a fairly healthy clip this quarter and for the year as a whole, and this growth has been led by both industrial valves as well as construction and mining business, where we sell excavators, backhoe loaders and vibratory compactors. The margins have, however, been somewhat affected again due to higher input costs as well as lower exports. The net segment asset increase is primarily driven by capex, which is driven by capex in Coimbatore campus. One of the factories has been set up for valves. Finally, as far as our outlook is concerned, since we are largely in the infrastructure sector, a lot of external and internal factors affect our fortunes going forward. And in this slide, we have tried to summarize whatever we thought has a relevance to our performance going forward. We are seeing increased spends on infrastructure with focus on roads and power primarily. Government finances does seem to be improving. We have an improved fiscal deficit, central fiscal deficit that is. It is expected to be around 5.5% by the end of this year. Favorable monsoons will be contributing to higher GDP as well, and we do have a higher GDP growth forecast. The Reserve Bank of India does follow prudent monetary policies, and in spite of high inflation and high liquidity, we do think that it's fairly under control. These are the external factors. Internally, we have a very sound business strategy which will have a huge outcome on our...
Well, the details appear to be that the company is still holding on to its guidance of, both in growth in its order book as well as growth in total sales for next year. But at the moment, you could complain of a bit of disappointment on the margin front at 10.5. It's not even looking good as the 10.8 that we thought originally, and certainly lower than the 11% plus that was expected by the street. So perhaps there will be a bit of a disappointment on the margin front. We saw the L&T stock moving down because of that, but on other fronts they are just expecting that perhaps the order book will grow more substantially in the second half. A number of orders they have been postponed, the management pointed out, and therefore perhaps the second half will make good what has been a distinct slowdown in the first half. But still the revenues have come up good, better than what the street expected. It's the margin front that is certainly intriguing. Well, the rest of the management is also waiting by perhaps to take Q&A. We'll get to them in a minute. Gautam is here with us. Gautam, give you 60 seconds. What are the main things that you picked up from the management?
Well, Lata, the H2 story was pretty much known that the ramp-up is going to happen in H2. The only perhaps problem area is that E&E is under pressure a bit, because here you've seen sales go down by about 5% and also margins decline by about 200 basis points year on year. So this segment is looking a bit weak, and that's because of what's happening in the domestic market and also the slowdown in the international market. So competition is a bit of a problem here. Okay. But apart from that, the others seem to be pretty much. All right,
Gautam, Mr. Deosthalee is speaking, so let's hear him out too.
Information if you want, but I thought of clarifying a few points, some important elements of these results which need to be understood properly. The first point is on order inflow. As of today, end September, we are higher by 29% in order inflow as compared to the last year. And our indication for the year as a whole is 25%. And all of you know that these orders do not flow evenly in all the quarters. So looking at the potential, looking at the opportunities which are available in the market, we feel confident of achieving that 25% growth for the year as a whole. That's number one. The second important point is that last few quarters, except for the last quarter of the last year, there have been some anxiety in the minds of investors about the conversion of orders into revenues. You would have seen in this particular quarter our E&C projects revenues grew by 19%. Although the overall growth in sales was about 18%, that was mainly because of degrowth in electrical business group. The growth in the sales for E&C business is almost 20%, which indicates the pace of execution. And therefore, again, for the year as a whole, what we have indicated as 20% growth for the company. And also, I must clarify, most of this growth is going to come from the order book which we had at the beginning of the year. It is only the cycle of execution which is important. Based on that, we have indicated 20% growth for sales, and I think there again the confidence level is pretty high in achieving for the full year 20% growth. The other important point which I want to clarify is, although Mr. Mondal mentioned about marginal increase in or small increase in margins, in my view, it's not really, we should not really look at marginal or small, because the margins themselves are pretty healthy, and to grow even 20 basis points on that is an achievement. So you would have seen that the E&C project business, which is more than 85-86% of our total business, there has been a growth in margins for the quarter as well as for half year, and that growth is in excess of 1%. Although for the company as a whole it is about 20 basis points. For E&C projects, which is the most important or the largest segment of the group, it is more than 1% growth. In fact, it is about 1.3 and 1.5% for quarter as well as for the 6 months. Therefore, this is, I'm not suggesting therefore that then you will see an increase in margins for the year as a whole. This only demonstrates the point which we made, that we will maintain our margins for E&C business for the year as a whole. Quarter on quarter, there is a possibility that in some quarters there will be an increase, some quarters there may be flat, there may be a small drop also, but for the year as a whole, it is we have given an indication that we will maintain these margins. Now, the most important point of these margins is that this is in spite of the fact that there has been substantial increase in commodity prices in the last 6 months. In these 6 months, copper has gone up by 24%. Aluminum prices have gone up. Steel prices have gone up. Except for cement, all the major commodity prices have gone up. In spite of that, there has been a healthy growth in the margins for E&C business.